Hello and welcome to the Market Talk on Wednesday, the 10th of December, 2025. Today's episode previews the impending FOMC interest rate decision due later today. To be precise, the decision will be announced at 1400 Eastern Time. That's 1900 GMT. And 30 minutes later, we'll have a press conference headed by Fed Chair Jerome Powell. We'll get that out, and that's 1930 GMT, 1430 Eastern Time. To help me figure out what it all means, I'm joined today by two venerable guests. Firstly, by a market-savvy expert and regular guest on Market Talk, Choi, author of popular market blog, The Curve Advisor, and Sam Cutler, another regular on the show and portfolio manager at 333 Capital. Good morning to you both still over there?
Yeah, nice and early in the morning here, Harry. Hey, Joe. How you guys doing?
Thanks for having us on.
Always a pleasure. Okay, right. Today we do have the FOMC to discuss and really just look over the finer points of what to expect. For anyone wanting to look at a preview, there is one on the LiveSquawk's website, FOMC preview. Have a look at that. We're looking for a 25 basis point rate cut, which will take the range down, the Fed funds range down to 3.5%. This is said to come amid rising labour market risks. We've had, limited data we've had on the labour market seems to show just a loosening of the jobs market there. We're also this is also an SEP quarter, so we'll get SEP revisions and forecasts and the dot plot to be updated. And it's flagged potential dissent also from both hawks and doves, so we could get a high number of dissents there. But we'll cover all this as we go along. There is a report here from JP Morgan, if I can find it, that I wanted to sort of go over quickly to give us some sort of context around today's announcement. So this is a piece from JP Morgan's Michael Ferroli in previewing today's decision. They look for two dissents in favour of no action and one in favour of a larger cut. He says the interest rate forecast dots will also reflect unease about cutting, as we expect only a slim majority of the 19 committee participants will have penciled in Wednesday's cut as an appropriate action. As was the case in September, we think the median participant will pencil in one more cut in each of the next 2 years. Likewise, we do not see reason to look for large changes to the economic forecasts, and we look for the forward guidance in the statement to reference the extent and timing of additional adjustments, a subtle shift to indicate a cut is less likely at subsequent meetings. Off the back of it, and then if I bring in Sam first of all, what are your initial views of? I know we talked about this last week on the weekly review, but what are you? Has there anything changed in your view of today's decision, and what is your initial, views on what we'd like to see?
Yeah, no, nothing's really changed. I mean, I think it's pretty clear out there. The consensus is going to be for 25 bips cut with a little bit of a hawkish lean. And, I think that hawkish part comes from Powell's presser, where he's just going to kind of emphasize, the typical stance that the Fed is data dependent, that future cuts are, they're not guaranteed. And like you mentioned, like we spoke about last week, I think the data is still murky with the government shutdown, and we're not going to really get cleaner reads on the data until January, February. There is some evidence the labor market has, kind of troughed and recovering a little bit, but we still have a really big mixed picture on that front. And, you just to speak on that further, you got the JOLTS report yesterday, which, really wasn't that great. You had most of the gains in one sector, and that trade, transportation, and utilities. But that's just the headline numbers, right? And you had the Indeed job index tick up. So it was, kind of expected that, the JOLTS could come up, but the downtrend might be a little bit intact. But whatever, the numbers surprised a little bit to the upside. But there was a little more going on than just that, like the quits rate, that ticked down, which is a red flag. And if you look at this, on the Beveridge curve, we're kind of sitting right at that kink, right? Where the job opening rate, if it ticks down anymore, it's going to be accompanied by, a much rapider rise in the unemployment rate. So I'm curious on this, where the SEPs are going to be for, the unemployment rate going into next year. On the dot front, if we go back to the last step, I think they had just one 25 bips cut projected in 2026. So I think it's worth, paying attention if there's a change there. If you're looking, at US one-year rates, they're sitting at about, 3.23%, which is implying, about 66 bips of cuts into next year. So I think any deviation from that could move the market. Like you mentioned there, dissents are continuing to grow, right? You have some of the hawks, Mussolini, Collins, Goolsbee, right? They've shown a little bit of reluctance in recent comments to support another cut, and then on the contrary, on the dovish side, you have members like Schmidt and of course, Moran, who is always going to want more aggressive cuts here.
We kind of discount Moran, don't we? Let's be honest, that's a given, and so we kind of discount his viewpoint on this anyway. I guess maybe we shouldn't, but I think generally speaking, there's only one.
I think we should. Again, it's hard to take anything really face value from someone that's I think is just viewed as kind of a placeholder and obviously very, very political in their decisions. Is going to be interesting to see if they address a little more technical points on the balance sheet, right? Such as some term repo operations or reserve management purchases of some sort. And then just on the last note, just from this morning, right, because we got the employment cost index today for Q3, which actually rose at the slowest pace in 4 years if you look at it on an annual basis. So it's kind of just another tick in the softening job market column, which kind of also helps limit inflationary pressures here, right? And if you look at market-based inflation expectations, since October, they've just been, kind of moving substantially lower here. I mean, you look at the 1 year rate sitting right around 240, and that super volatile, 1 year 0% coupon inflation swap that I don't like, but it's a decent gauge of market expectations. It's dropped from 3.2% to 4.28. So market-based inflation expectations have really pulled in.
Yeah, Joe, do you have anything to add? I mean, you're a short-term interest rate trader, so you look at that short end of the curve. What are your initial views on what to expect?
Oh, so I think we could get some fireworks from the meeting, but not really the meeting results, and probably not the market reaction either, because I think the ease at this point is pretty much priced in, and the hawkish ease is also somewhat priced in. I actually think this might be Powell's last ease, if assuming we get some sort of a rebound in, from the shutdown, because I think part of the softness of the data was just from the shutdown. But, we could talk about the economy more later. So I think, the reason why I think we could see some fireworks from the meeting results is that I think there could be a lot of dissents. So I'm actually thinking we could get as many as, at least 3 hawkish dissents. And Myron could always put in a dovish dissent as well. And then, I'm wondering if they're going to do anything related to providing more liquidity, because the SOFR and Fed funds fixings have been a little bit more elevated. I think there were some economists calling for an IO interest on reserve balances cut this meeting, but I think most are expecting the Fed to signal something like that. So it'll be interesting if they want to try and put some more downward pressure on the fixings. And then let's see. So the Fed's going to ease, but to me, it actually seems like a majority of the FOMC wants to pause. But the way the voting structure is, most of the bank presidents want the pause, but not all of them get to vote. And so and then on the flip side, you have these 3 governors that are either a shill or vying for the new Fed job. So they're all going to be voting for the cut. And so I think if you just looked at all 19 members, it would not surprise me if a majority of them wanted to pause. But because, Yeah, so it'll be interesting just to see how the voting dynamics work, because I do think, because the data has been a little soft, that Powell was probably able to reel in some potential dissents. But that's why I think it's possible that the Fed may not, ease that much more. And then I guess in terms of what to expect from the SEP, I think core PCE is running a tenth or two below what the Fed had last time. So that's going to also add a little bit of a dovish tilt to what comes out.
Right.
And then there isn't much room on the dots to show a hawkish bias, since the median dots, I think most people are expecting to be unchanged. What I will be looking at, though, is I want to see what the dispersion of the dots are, like to see if, because last time we had a whole bunch of
25%.
Hello?
Yep.
Oh, so last time, we had a whole the Fed was split, and I'm wondering if the split got worse or if it got better. Just in looking at the clustering of the dots. And then just related to the dots, the long run rate is expected to be to rise up an eighth to 3.125. And this is actually so the last time we were only one dot away from printing 3.125. So I'm not sure if if the markets, so one of the small reasons for the sell-off recently could just be a repricing of that neutral rate. And so I think because Powell probably won't have an opportunity to signal the hawkish cut in the SEP, I think it may have to be something that he says. So I'm gonna just take a look at how hawkish Powell's tone's gonna be, because I think the price action leading up to the meeting has just been to sell off the part of the curve that had the eases for this year.
Right.
So if in anticipation of this hawkish cut, and I kind of think if Powell just doesn't say anything exceptionally hawkish, that we could see a little bit of a rally back. But that's basically what I call wild ass guessing. Like trying to pick direction. But I do think the market might be leaning that way.
Okay, good to know. Well, yeah, I mean, looking at a lot of the research that I've read up on there is this consensus really that this is going to be a hawkish cut, and this could be we could see a pause near term. There's an RBC piece here that looks at the language and says the statement is likely to signal a lower bar for a pause by reverting the language on additional adjustments to include the extent and timing. That's RBC's there, and they say on the messaging, Powell will likely remain non-committal, emphasising the importance of incoming economic data, and he's expected to downplay the meaningfulness of a single 25 basis point cut. I think that's I don't entirely agree, because I think the last meeting we had back in October, he was at pains to make everyone aware that December was not a done deal. And so I tend to agree with, from what my opinion is worth, that there is a reluctance to cut here, but it's now kind of baked into the pie, and there's a reluctance to, again, disappoint the markets on that front. Sam, to you on the economy, do you think it warrants another cut at this moment in time? What you just said about maybe they don't want to in the first place.
Yeah, no, I don't, and I think one of the reasons here, like I told you before, I still think we need some cleaner reads on the labor market, because there has been a deterioration, but how much has that already played out? Like Joe said, was that just like a product of the government shutdown adding into the weaker data as well? Because look, if you look at, let's just take it at the unemployment rate as a whole, right? That's up about 30 basis points since June, and about a full percentage point in this cycle. So if we make an assumption, let's say that maybe the real neutral rate is 50 to 75 basis points, right? And we see underlying inflation here running, let's just say it settles around 250 to 275, right? So you have neutral at 3 to 3.5%. So I think from here, with how the 1 year is priced, right around, that 3, let's call it right in the median of that. I think it's at like 323. So kind of right in the middle of that 3 to 3.5%. I think you're going to really need tangible data showing, more deterioration in the labor market for this to reverse some here.
Okay, cool.
So I think, I think it's on hold, but again, you could get a political Fed chair that has some persuasion, next year as well. So there's that risk as well. But from a pure economic standpoint, I don't see any reason to cut rates further here based on what we know at this point in time.
Have we moved away from this argument about labor then versus inflation as such? And this is, again, maybe it's a bit more politicized than it was before. Again, Joe, I've read a couple of your blogs of late, and you've mentioned the fact there's been a lack of clarity in terms of data that we've had to look at, and there are other bits and pieces. We've got the ADP data, and I read a paper on the significance of the ADP paper and its relevance compared to national sort of data, which I found quite interesting, and I'll put the link up there afterwards. But is this less about labour market versus the inflation, that fight, and just simply more about the economy isn't slowing down, the economy isn't on a knife edge? We are looking fairly solid. I mean, all the way through this, we've seen a very decent household demand. We've not seen a massive pullback in consumption, really, not in any meaningful way. So, I'll ask you the same question. Is it necessary to cut rates at this moment?
Well, so I can see why the markets are, have priced in the rate cut and why the Fed hasn't pushed back. But I guess for me, it's just not clear that the small amount of weakness that we got isn't just from the shutdown. Because, the government was shut down for a month and a half. And so you would think that, and then they have a multiplier effect, like through contractors or, just local restaurants and things like that. So, sure. So the government being shut down for a month and a half, I mean, it's not clear that that's not why, jobs declined, let's say, 40,000 or whatever. And it's not clear to me that now that the government's reopened, if we're going to see a snapback in a lot of the data. Because right now, some of the preliminary surveys for November payrolls, it's going to come out. When is that going to come out?
We've got October, November. When are we coming out? This week, the week coming. So next week, we should be getting October, November NFP.
So it's not clear that the data is going to start picking up again. And then I guess the other thing is, now that we're close to the new year, we might get some tailwinds from fiscal policy, because a lot of, like, some of the provisions of the One Big Beautiful Bill will come into effect, and people will start getting their refunds and things like that. So.
You also got that stimulus that announced for farmers, hasn't it? There's $12 billion stimulus for farmers, or funding for farmers as well, that's just been announced as well.
So I think all those little things might start adding up. But actually, one thing Sam said, which I thought was interesting, is just the the new Fed chair talk. So I think the market narrative is that the new Fed chair is going to be super dovish, and where the markets are right now thinking it's going to be Hassett. I think the odds are probably like 75 or 80%. I haven't looked recently.
It's up there.
Yeah. So I think in the beginning, it made a lot of sense to pile into some kind of steepener, thinking that Hassett would drive the eases. But but I guess since Hassett has been suggested, there have also been some discussion that he may not have enough credibility with the Fed to pull off anything because he is just one vote. And so I think that might be one of the reasons why we've seen the 2026 eases get taken out in large chunks. So I'm not sure if that, what the one Fed chair can do by himself. And I think that might be why in recent days we're seeing like additional pressure from the White House. So whether it's Bessent saying that, Fed presidents who don't live in the area need to, shouldn't be shouldn't be bank presidents. And just today, Trump said something like, what did he say? Oh, he said that he can fire governors, like that Biden allowed with an auto pen, like things like that. So I just feel like so there's actually going to be like a bigger picture theme of the White House constantly putting pressure on the Fed members to vote a certain way. And what I'm going to be curious to see is to what extent Powell and the other Federal Reserve members like either fight back or give in, because that could actually, more than the fundamentals, which is what I focus on, that could actually be a larger driver of rates than the actual unemployment and inflation.
Well, you make a good point, and I was going to come back to the fact that the Fed chair is there to steer the committee in a direction and to coalesce his colleagues into a joint decision. The dissent that we're likely to see normal, or is that not natural when you come to a pivotal point in a rate cycle? Anyway, you are going to get more dissent because there are those that are conflicted between whether it's now's the time to hold or now's the time to cut, compared to those that think we can carry on, or whatever. So if we're nearing a natural end to the current rate cutting cycle anyway, the dissent could be a bit misleading on that front. I do recall that everyone was, something that was, I guess, noted at the first Myron meeting was that all the other members appeared to unionize and come together, and it was, Myron was left on his own to a degree, or that was the feeling that they all sort of huddled round Powell and Cook and made a point, were pointedly saying, look, we're together, we're a unit. So I do think the market is a little bit maybe ahead of itself in terms of thinking that it's going to be an automatically dovish Fed. The language may be that way, but it's the actions that we look for, really, I guess. Sam, would you agree?
Oh yeah, 100%. Even when the market was pricing that, I kind of agree with what you and Joe were saying. Although he maybe the Fed chair may lean a little more dovish, you still have all these independent opinions, and yes, they could follow the Fed chair, but again, at the end of the day, it's one view on, versus a ton. So I don't think one person can drive the Fed as much as the market thinks sometimes.
We're coming to the end now. We'll have the press conference. We'll hear from Powell, and I guess there is an assumption that today's move will be a hawkish cut. And as we've seen before, he doesn't always play ball, and he's got less reason to play ball now than ever. He still doesn't leave until is it June or July of next year? I think his tenure ends around that time. I could be very wrong on that, but that was my. I can look it up. But in the meantime, the question stands. How, and we were talking about credibility, and I'll start with you this time, Joe. The credibility of the Fed moving forward, then how much will you base your trading around what the Fed actually says anymore, moving forward once Powell's out the door, and if it is Kevin that comes in, will you view it in the same level of credibility, or do you then take everything with a pinch of salt? Or how do you face up to that?
Well, it's kind of hard to speculate now, assuming Hassett gets the role, and I'm not certain that he will. But assuming he gets a role, I think it depends on which Hassett shows up,
Mm,
because it's possible that once he gets the job, he may, uh, he may act a little differently than him just coming on TV right now and just saying whatever the White House party line is.
mm,
Because at the end of the day, he may realize that he's going to need to corral all these people with different views, and him spewing the White House message is not going to get that job done. And to be honest, if anything, I think that could turn a lot of people off. So
mm,
usually I count the Fed chair, like Fed chair's voice, fairly high in terms of the sum of the voice of the Fed.
right.
But I could actually see a partisan Fed chair actually being worth negative votes, meaning like he could end up being so divisive that he starts pushing people the other way.
Mm,
Because the thing is the majority. My understanding is that a solid majority of the Fed are Democrats, and
right.
the thing is, I'm a Republican, and I'm very put off by some of the things, Hassett has said, Mirren has said, that the White House is saying.
Mm,
And so I could totally see a room full of, or mostly full of Democrats, like listening to this guy and just, wanting to do the complete opposite of what he wants to do. So I think, he has a very challenging role ahead of him, assuming he gets this position. And so, but that's all part of trading, just factoring that in, like
yeah.
to figure out, how is this new voice going to affect the odds of the Fed easing or hiking? Because at the end of the day, I don't trade the unemployment rate and the inflation rate. I trade, the actual cuts and hikes, and so. So that'll be something that I'll be developing as the year progresses.
And am I right that even though he won't be Fed chair, Powell can stay on until Jan 2028? He's due to finish in May, by the way. In May of next year, his term expires as Fed chairman. But he's indicated he may not depart the Fed entirely, and he could remain on the board of governors, and that extends until January 2028. So, I mean, his influence may stay on beyond his chairmanship, potentially, and this is
Oh,
my speculation there. So,
oh yeah. So Kalshi actually has the odds at 30% that he'll stay.
right,
Uh, which is somewhat high considering most Fed chairs leave.
mm,
And so this again is that battle within the Fed of how strongly they're gonna fight for the Fed independence,
mm,
that I mentioned. So whether they're going to fight for independence or they're going to acquiesce to all of Trump's pressure. Because if Powell stays, that is actually going to drive a huge wedge in terms of what the White House wants to do,
mm,
because they will have one less seat now. Like they were probably counting on this one seat so that they could get a majority of Fed governors,
right,
to be voting on things, and then it would actually be kind of ironic because Bessent had been talking about having a shadow Fed chair to slightly undermine Powell, and now Powell could be the shadow
yeah,
Fed
shadow,
chair that's going to undermine, Hassett or whoever the White House picks.
sure. Sam, any views on this?
No, nothing to really add on that. My views kind of align with what Joe said there. It seems very probable. The only thing is, it's hard to see this from Powell's point of view, but if I was in Powell's shoes, I would not want to stay on. after it seems like it's been a rough couple of years. I think he's done a great job at, kind of navigating these markets and the economy. I'd be ready to step down.
Yeah, I tend to agree, but at the same
there
time,
might be that inner, kind of wanting to stick it to Trump, and like Joe said, how he would kind of act as the shadow.
That was my point.
Yeah, I think that could be something that could kind of persuade him that way, but I don't really have any strong views on it one way or the other.
Fair enough. It is speculation. It was just a bit of fun. Anyway, we're now at the end of our half hour, just over. So just to quickly recap, then we're looking for a 25 basis point cut today. More than likely, we'll get signals that this could be the last cuts in the near term, at least, with updated dot plot potentially showing just one cut for 2026. Likely revisions to the staff projections are likely to be modest, according to most analysts, with 2026 dots to draw the market focus. Analysts flag potential dissent from hawks and doves here, and some suggest we could get as many as 5 dissenters on either side of the aisle, really, for today's meeting, but we shall see. I think the consensus is more for around 2 or 3 potentially. The announcement comes at 1400 Eastern Time, 1900 GMT, with a press conference 30 minutes after that. I'd like to thank my 2 guests, Sam Cutler of 333 Capital. Thank you very much.
Always a pleasure, Harry.
Thank you. And Joseph Choi of the Curve Advisor. Thank you.
Oh, thanks for having me on.
Pleasure. And yes, you can listen in to LiveSquawk.com to hear the announcement today. Take out a free trial at LiveSquawk.com to see if it could help your trading day out. But good luck today for those trading around today's announcement. And we'll see you again for our weekly review and the next FOMC in the new year. Thanks a lot for listening. Bye-bye.